You don't have one money problem, you have 10, and not one of them ever sent you an alert because none of them were ever big enough on their own to notice. A few dollars here, a percentage there, a payment you stopped questioning years ago. By the end of this video, you're going to add all 10 up. Most people who do this get a number that changes how they see their own bank account. Some of these you'll recognize, some you won't. Let's find yours. Start at the checkout counter. You just bought something, a laptop, a washer, a TV, and now someone's asking if you want to protect it. 2 years of coverage, one flat fee, right now, before you walk out. Here's the bias doing the work. Probability neglect. Your brain is bad at weighing small chance of a big loss correctly. It rounds the small chance up to feel bigger than it is. Because losing feels worse than the price of not losing ever felt like a bargain. Run the real numbers on this category and the pattern holds across almost every product line. The payout rate on these plans, what actually comes back to customers in repairs, tends to sit well under half of what's collected. The rest is margin, built on you overestimating how likely you are to need it. That doesn't mean it's always wrong to buy one. If a single repair would genuinely wreck your month, paying for certainty can be a reasonable trade. The problem is buying it on reflex at the counter under time pressure without ever running the math, which is exactly the moment it's designed to be sold to you. Second one's quieter because it doesn't look like a fee, it looks like a button. You're checking out, a bill, a delivery order, a ticket, and there's a small charge added automatically. Convenience fee, rush processing, late fee, already applied. None of it was ever optional once you got there, but none of it ever felt like a decision either because the interface made the default the one that costs you. That's the mechanism, default bias. People overwhelmingly stick with whatever's pre-selected, even when opting out takes one extra click. Companies know this. It's why the fee is added automatically, and the waiver, if one even exists, is buried 2 menus deep. Stack a handful of these across a year. A late fee here, a rush fee there, a service charge you never toggled off, and a household can realistically be paying several $100s for defaults they never actively chose. It's not that any single charge is outrageous. It's that you were never actually asked. You were opted in, and the exit was made just annoying enough that most people don't bother. Third one people are usually pretty honest about. Most players already know the odds are bad. So the interesting question isn't why do the odds suck? It's why the bad odds don't stop you. That's optimism bias, plus something more specific, the near-miss illusion. 2 numbers off gets processed by your brain almost like a partial win, even though mathematically it's identical to missing by all 6. Scratch tickets are built around this. Near misses are common by design because a near miss keeps you playing the way an actual loss doesn't. A few tickets a week doesn't feel like spending. It feels like a small ritual. Add it up over a year and it's a real number, often several $100s, for a return that's structurally worse than a casino slot machine, which in most places is legally required to pay back a majority of what it takes in. That gap is worth sitting with. You can walk into a casino, sit at the worst machine on the floor, and still get better odds than your state's scratch ticket. Nobody frames it that way on the packaging. That's 3 leaks so far, 7 more. You already know Marcus and Dana. This is the part of their money life the first 2 videos never showed you. Marcus almost fell into this one before the skim line ever existed. A repair bill landed on the card, and for 2 months he paid whatever the statement listed as the minimum because it was there and it was easy, and it wasn't the number he was actually staring at. That's the trap. The most expensive money most people will ever borrow is also the only loan they never actually shopped for. The mechanism is hyperbolic discounting. We consistently value avoiding a small cost today over a much larger cost later, even when the later cost is mathematically guaranteed. Paying the minimum feels like handling it. It's also the slowest, most expensive way to ever pay off a balance. Here's what that looks like on paper. A 5-figure balance at a typical card rate, paid at minimums only, can take well over a decade to clear. And by the time it's gone, the total interest paid can exceed what was originally charged. You end up paying more for the interest than you paid for whatever you originally bought. The minimum payment isn't a payment plan. It's a number your card issuer calculated to keep the balance alive as long as legally possible, while keeping you current enough not to default. It was never designed to get you to zero quickly. It was designed to get you to keep paying. Money flowing into betting apps has been linked, in research tracking real household finances, to a measurable drop in savings and investment activity, not a one-for-one trade, a net drain. That's item 5, and it's grown fast for a reason. It's dressed differently than the other forms of gambling on this list, deliberately. The mechanism is illusion of control. A slot machine doesn't pretend you're skilled. A betting app does. Stats, odds, live lines, cash-out buttons that make quitting mid-bet feel like a strategic decision instead of what it actually is. That framing matters. People are far more willing to call sports betting investing than they are to say the same thing about a scratch ticket. Even though the underlying math, the house has an edge, and it's built into every line, doesn't change. That drop in savings tends to land hardest on households with the least room to absorb it, which is its own quiet unfairness. But it's not that betting itself is irrational to enjoy. It's that the app is built to feel like a financial decision, which makes it far easier to justify than a trip to a casino ever was. Sixth one you'll never get a bill for. It never leaves your checking account. It just quietly leaves your future account. The mechanism is fee blindness. A percentage feels small because it's a percentage, not a dollar amount. 1% sounds like nothing. It isn't. Here's the arithmetic that should change how that number feels. 2 identical portfolios, same starting balance, same growth rate, same 30 years. The only difference is a 1% annual fee. By the end, the fee-paying portfolio doesn't just lose 1% a year. It loses everything that 1% would have compounded into every year for 30 years. On a large enough starting balance, that gap can run into the hundreds of thousands of dollars. Most actively managed funds, tracked over long periods, fail to beat a simple low-cost index benchmark. And the data on this has been remarkably consistent for years across almost every fund category measured, which means the fee isn't just a cost. It's often a cost paid for underperformance. None of this means all advice is worthless. A fee-only advisor who keeps you from panic selling during a crash can be worth far more than they charge. The problem is paying advisory-level fees for a portfolio nobody's actually advising on. That's 6 leaks so far. 4 more. A guy named Trevor traded in his truck 18 months into a 6-year loan, still owing more than the truck was worth. He told himself the new payment was basically the same number as the old one, so it couldn't be a bad move. And that's exactly how he never had to look directly at how much debt he'd actually rolled forward. The finance guy read him one number, the new monthly payment, and Trevor signed off on that number alone, without once asking what the total balance now actually was. That's item 7, and it's sitting in a lot of driveways right now, quietly losing value while nobody's watching it happen. The mechanism is payment anchoring. Most people judge whether a car is affordable by the size of the monthly payment, not the total amount they'll actually pay. Stretch a loan from 5 years to 7 and the monthly number drops just enough to feel manageable, while the total interest paid and the years spent owing more than the car is worth both climb. That second part is what caught Trevor. Being underwater, owing more than the car's current value. It's an increasingly common position for buyers trading in mid-loan, and the fix on offer is almost always the same shape. Absorb the old debt into a new, longer loan, so the monthly number stays anchored in a comfortable range while the total owed quietly grows. A car bought a few years used, financed on a shorter term, can save several $1,000s a year compared to the new and stretched version of the same decision. Money that, invested instead, compounds into something a monthly payment number never shows you. Eighth one hides inside something that's supposed to save you money. You're at the store, and the bulk size is a better per-unit price. Genuinely true, printed right on the shelf tag. So you buy the big one. A loan. For one person, or a small household that will never actually finish it before it expires or goes stale.
The mechanism is loss aversion, reframed. The deal you're chasing is the unit price, but the number that actually matters is total household waste, food, product, or space you paid for and never used. A large container thrown out half full isn't a discount. It's the same waste as buying the small one and throwing half of that out too, just with a bigger price tag attached to the loss. This one's sneaky, specifically because it feels like the financially responsible choice. You did the math on the shelf tag. You just didn't do the math on your actual consumption. Buying to the size of your real usage, not the size of the best printed unit price, is a small habit shift that can realistically save a single person or two-person household a couple $100s a year in food and product that never gets used. Dana's one-way vault fixed her biggest leak. It never touched this one. Coffee on the way in, a delivery fee she barely registers, a small "I earned this" purchase after a long shift. None of it ever passed through the automatic transfer, because none of it ever felt like real spending in the moment. That's item 9, and it doesn't feel like spending at all. That's exactly the design.
The mechanism is mental accounting, the very human habit of sorting money into separate mental buckets instead of treating it as one pool. A $5 coffee, a delivery fee, a small "I earned this" purchase. Each one gets mentally filed under too small to count, completely separate from the budget you actually track. Individually, that's true. $5 doesn't move a budget. But treat culture spending rarely happens once. It happens as a pattern, a small reward for a hard day, repeated most hard days. And a hard day is not a rare event. Tracked honestly across a month, these too small to count purchases routinely add up to $50 a week or more for people who would swear, accurately, that they don't spend much on any single treat. The fix here isn't guilt, and it isn't cutting out small joys entirely. That approach doesn't last for anyone. It's moving treats into the budget on purpose, as a real line item with a real number, instead of leaving them in the mental blind spot where small quietly becomes constant. That's 9 leaks so far. One more. How many things are you paying for right now that you've genuinely forgotten about? Not guessed at, actually forgotten. The kind you'd swear under oath you don't have. That's item 10, and it's the one almost everyone underestimates, and not by a small amount. The mechanism is status quo bias. Once something's running automatically, stopping it requires an active decision, while doing nothing requires none. Every subscription is built around that asymmetry. Signing up takes one click. Canceling usually takes several, often with a retention offer or a guilt trip screen in between, engineered by people whose job is to make the several clicks feel like more trouble than they're worth. Ask most people to estimate their monthly subscription spending, and the number they guess is reliably significantly lower than what a real transaction audit turns up. Not because people are bad at math, because half the subscriptions being counted were forgotten entirely. A service nobody's opened in months, still charging, still invisible, because it never once demanded attention. Open your own transaction history right now, today, and actually read every line for the last 3 months. Most people who do this find at least one thing they forgot they were paying for. Some find 4 or 5. None of them find 0. 10 items. None of them alone would ever make you feel careless. Together, they're the difference between a household that's technically fine and one that's actually building something. Here's what adds these up in the real world. Take a household earning a solid, ordinary income, doing nothing anyone would call irresponsible, carrying a normal mix of these 10 habits, and the honest total routinely lands somewhere between $4,000 and $10,000 a year. Not from one bad decision, from 10 small, reasonable feeling ones, repeated on autopilot. Run that number forward the way money actually behaves over time, invested instead of
leaked, growing for 30 years. And it doesn't just disappear into a bigger number. It turns into a meaningful chunk of an actual retirement, the kind of number that changes what comfortable looks like at 65 instead of 80. Here's your assignment. It takes about 10 minutes, one item at a time. Go through all 10. For each one, write down whether it applies to you and roughly what it costs you in a year. Don't guess. Check your actual statements. Add the 10 numbers together. Write the total down, not in your head, actually written, somewhere you'll see it again. Then don't act on it for 72 hours. When the 72 hours are up, ask yourself one question. Which one of these 10 had you quietly calling normal instead of calling it what it actually is? A decision made on your behalf by someone else's default setting. Whatever you decide then is the real answer. Find your 10.